nuclear power, critical minerals, high-speed rail. The federal Liberals have a long list of big, expensive projects they say will help Canada realize its economic potential. But should pension funds and their very, very deep pockets play a role in making them happen? Matthew Mendelsohn is the CEO of Social Capital Partners, and Keith Ambachtsheer is the co-founder of KPA Advisory Services and Director Emeritus of the International Centre for Pension Management at the University of Toronto. Matthew, great to have you in studio. Keith, great to have you on the line from Fonthill, Ontario, Niagara. I want to start things off with a breakdown of assets owned by Canadian trusteed pension funds, almost $2.5 trillion worth held around the world. And as you can see, domestic assets are at almost $1 trillion, while the combination of foreign and unknown nationality assets are a little more than $1 trillion. Keith, I want to start with you. What does this chart tell you about the interest of Canadian pension funds in investing in home here in Canada?
One word that comes to mind is diversification. The people that manage this money have a fiduciary obligation to think about risk and to manage both risk and return. And so when you get to the kind of sizes that we're looking at here, obviously you can't all invest in one country. You have to seek diversification around the world. And so the discussion becomes, either optimal amounts as to what you invest at home versus what you invest outside the country. And that's part of a live discussion that's ongoing. But I think the key principle here is that you can't stick all this money in one country. It has to be invested globally around the world. And our funds have gotten very good at doing that, especially at the big end where they actually have offices around the world to do this investing globally on behalf of Canadian pensioners.
Matthew, Canadian pensioners are well served by pension funds, and other countries use us as a model. We can talk about, the speech in Davos where Mark Carney gave a shout out to the pension funds there. Why should the obligation of pension funds go beyond simply the best return?
Well, it's a big question. Keith is right. I agree with everything Keith said. It's really important that our pension funds are diversified, that they invest across asset classes, that they invest across geographies. They are very sophisticated, well respected. But I would add that at this moment, given what has happened over the last 2 years, we all recognize that the world has changed. The nature of risk has changed. Our largest trading partner has clearly changed, and there's a lot more risk in investing in the United States, and the United States is also seeking to do us harm at the moment. So we have seen from our governments a deep belief that it is important that governments rethink geopolitical strategy, how we invest, how we build the economy. As you know, the Canadian government is out there trying to attract $500 billion of investment. So I think at this point in our history, it's really important that all institutional investors, pension funds, but others as well, big family offices, charitable foundations, endowments, all of us think about whether there are additional things we need to be thinking about other than just market-adjusted returns. And I'm not saying those aren't important. Risk-adjusted market returns are very important, but there are some other things to be considering as well.
When you look at the Canadian landscape, would a lot of these funds be a little nervous to change course, even if the surrounding environment is changing? If it's working, why change it?
Well, they certainly would be nervous. And that's an important piece to remember about how they're organized, how they work, how they incentivize their fund managers, how they organize themselves around their committees. So they would, over the last 20 years, have added climate risk committees, right? And so they're thinking about climate risk in ways that they didn't 20 or 30 years ago. Should they be thinking about sovereignty in ways that they weren't 20 or 30 years ago? Should they be thinking about the long-term value and investments that they are building here in Canada in ways that they didn't 20 or 30 years ago? You can see that, the federal government is looking at a whole bunch of different things, allowing pension funds to own more than 30% of a company, invest more in our infrastructure. And the federal government is actually incenting by putting in some money, trying to crowd in investment in mid-sized Canadian businesses, in venture capital. So there are lots of ways that the Canadian government and others can incent different kinds of investments. But there's no doubt that the people who are hired and incented and how their bonuses are structured, how they have organized across asset classes, what kinds of funds they have built, as Keith was talking about. They look all over the world. They're trying to build infrastructure in Europe and in the Middle East and or invest in those things. And that, of course, makes sense. But would it make sense to also be thinking really hard about infrastructure in Canada, scalable, affordable, or community infrastructure in Canada, putting more resources and looking at mid-sized Canadian firms that might scale? So those are things that I think would certainly require pension funds to behave somewhat differently, but I think it's time to have that conversation.
All right, let's take a little broader look outside of this province as well. I want to look over to our neighbors to the east in Quebec. Keith, the CAS has a dual mandate to also invest in Quebec itself. What has been CAS's experience with investing in Quebec's infrastructure particularly?
Let me just back up a little bit into the previous question. A lot of the way things are done depends on the governance and organization design of these plans. So dynamically over time, they have to be organized so that there's a board that oversees to make sure that the organization has the right talents. But then on a dynamic basis, the kind of things you're discussing and that Matthew's discussing, that's part of an ongoing discussion. It's called the total portfolio approach, where the kind of things that come along with the passage of time, get integrated into potentially adjusting the asset mix, the portfolio over time. So a good example of that is La Caisse de dépôt, one of the largest institutional investors in Canada. They were in the Globe and Mail this morning. They've just made a $1 billion commitment in Australia to a particular power plan that they're going to be funding. So it's a classic example of the around the world aspect of how these funds are managed through time and how they make decisions over time. It has to be done in a risk-reward sense, but you also have to, especially when you go into private markets rather than just buying bonds and stocks, where you really need to have some good infrastructure intelligence and experience inside that organization to make those kinds of decisions. So they're very much integrated into the economies, and they know what's going on, and that's part of their dynamic, ongoing decision process.
Keith, I'll stick with you, but what infrastructure do other Canadian pension funds currently own here in Canada? Give us a sense of the picture here.
Well, an obvious one that you may be driving on is the 407. Owned by CPP Investment Board to a significant degree. There are other examples, but one of the interesting things that we've learned over time is that it's more difficult in Canada currently to make those kinds of investments than it is in other countries. An example, for example, is Heathrow. Heathrow is owned by pension funds around the world in London. Pearson, not so much, because it's very difficult for pension funds to sort of wrap their heads around how they would invest in Pearson. It can't be done right now. So there's sort of a whole interesting discussion about how welcome this kind of capital is, how easy it is to make these kinds of investments. And that's an area where I think Canada still needs to do some work in terms of creating the environment that welcomes capital from around the world to make infrastructure investments in Canada. We should be doing more than what we're currently doing.
Matthew, I'll get you on there. Should we be doing more? I'm mentioning airports. Well, we've got potential expansions here at Billy Bishop. We've got expansions happening at Pearson. Talk to me a little bit about the challenges there in getting the infrastructure.
So I won't speak particularly about that project. I'm not an expert on that project, but an important consideration that I think that the Canadian government should be thinking about is how we mobilize our institutional investors, yes, to invest in infrastructure, yes, to expand these kinds of big projects, but also how to invest to build new things as well. The federal government right now is seeking investors from around the world to build new resource projects, new energy projects, new infrastructure projects. So I think it's really important that we use our huge resources to build new things as well. And from my perspective, our pension funds are amongst the most trusted, well-resourced, respected investors globally. And it strikes me that we should be doing more with them, because we are at a moment where the returns are important. There's no doubt returns are important, but we see with the Quebec pension plan, they also have an economic development mandate. I'm not saying our pension fund should have a dual mandate necessarily, but it is certainly possible to get really high returns while also thinking about the long-term economic development that is taking place. And I think most Canadians and many pension fund leaders will say the only thing Canadians care about is the returns. And as long as the returns are strong, everyone's happy. I just don't think that's true anymore. I just don't think that if the Canadian pension funds can get equally high returns, but investing in Canada, in our growth companies, in our resource projects, in our energy transition, or even in newer asset classes like affordable housing or community infrastructure, I just don't think Canadians, all Canadians will say the only thing that matters is getting the highest returns. I think they care about the long-term sustainability and growth and sovereignty of the country. And the pension funds do as well. Like they are trying to think this through. We are at a key moment here of rupture and change, I believe. And I think we have to have this conversation more directly.
Keith, let me get you in on there. Do you think pension plan members would be willing to sacrifice some return if they knew their contributions would be spent to strengthen the economy at home?
It's a really tough question to put to someone who relies on a pension to say, "Oh yeah, I'll give up some of my pension." I think the interesting question is that really necessary? Do we really need to go in that direction? I don't think we do, actually. A couple things. There's an interesting concept in all this called, the home bias. Pension plans around the world have a natural home bias to invest more in their own country than in other countries on a proportionate basis. So that's their why. Information. You have more information at home. You know more people at home, who to trust, who not to trust. So there's a natural home bias that's already, in the cards. Should it be more than it currently is? My sense is that if that happens, it should happen for the right reasons, not to give up returns, but to facilitate and create the opportunities to make those investments. And part of that relates to the kind of people that are part of these investment organizations. And I think the staffing there is tremendously important as to the kind of people that are there with the assets and with the potential opportunity to make those investments. We want them to have an entrepreneurial mindset. And again, as we were saying earlier, we're lucky in Canada to actually have these, especially the Maple 8, the really big organizations, Caisse de dépôt, CPP Investments, that have those kinds of people on staff. So we're actually quite well positioned to take advantage of home-based opportunities when they exist.
And I would just say that I believe that it is very possible for large pension funds and other institutional investors to think about their governance and their committee structure and how they are building funds and what kinds of investment opportunities they are looking for, and achieve just as high returns by investing more domestically. And I'm certainly not saying they shouldn't be investing globally. But putting aside the question, and I believe that the evidence is very strong that you can be looking domestically and organizing yourself for particular kinds of opportunities that may require a bit more work to find. Even though I believe that you can find just as high returns investing domestically, I genuinely believe for most Canadians, if they are investing in Palantir or Elon Musk or crypto. There are a whole bunch of things in private prison system. If you actually engage with Canadians about whether they would accept 0.5%, because these are not big differences. It's not like you'd be getting 12% versus 0%. You don't have to invest in Palantir. You don't have to invest in Elon Musk. You don't have to invest in the building of private prisons for ICE and data collection. You don't have to invest in those things. Doesn't mean you can't find other investments and find other returns. So I think that at this time, I would also add, you don't want to be investing in companies that you know medium term, long term, are going to be hurting the country, are going to be hurting your sovereignty, are going to be extracting wealth from Canada and preventing smaller Canadian businesses from growing and thriving and not getting access to the capital and not becoming more productive. So I think you can get very high returns investing in Canada, but I also think that we have to think about questions like sovereignty and our long-term economic growth much more than we have.
All right, I want to talk a little bit about the Protect Ontario Account Investment Fund. Not a lot of details yet so far. This was announced in the Ontario's budget earlier this year, $4 billion. Keith, how should it work? There's still some details out there that we need to know, but how should it work in order to attract private capital, such as pension fund investments?
Well, if you read the Globe and Mail, I actually had an op-ed piece on that topic just a couple of days ago. My concern with what I understand to be the current intent is that the Ontario government made it very clear that this new capital fund needs to be managed by a private sector manager. And so my question was in my op-ed piece, why? We have such a great reputation and we have this great ability to get these assets managed at a much lower cost than typically what's being charged, in the commercial private equity space. Like rather than 3 or 4% of assets, it's 0.4% of assets that can, through which you could be on through these public funds. So I think the idea is fine in terms of finding these opportunities in Ontario funded by Ontario funds. My question was around why does it have to be a private sector manager who has to manage this money? And I'm just posing the question. And actually, when you read the comments on my piece, there's some very interesting answers to the question that I won't repeat here, but it's an important question to pose.
Yeah,
Matthew,
and
get the last word. Yeah.
I agree that we have extraordinarily well-respected, competent, large public sector pension managers. The federal government with the Canada Growth Fund right now, and this is getting a bit into the weeds, but they have a public pension manager who is investing those funds, partnering with government. So we are at a time where it's not just let the market decide, let capital decide. All around the world, governments and private sector are coming together to build projects, co-invest. I mean, that's been one of the things that Canada has been focused on the last 18 months. How do we make it less risky for pension funds or others to invest in big things that are going to build our sovereignty, that are going to build housing, that are going to build infrastructure here in Canada? And we are at a moment where, a lot of our public sector fund managers can be managing other initiatives and other pools of capital and working with government to build our sovereignty, strengthen our food system, all the kinds of things that we're talking about, rather than just passively look around the world for the best possible return on our dollar.
Gentlemen, we're going to have to leave it there. Matthew, Keith, thank you so much. A wealth of knowledge at the table here. Really appreciate it. Thank you so much.